Hi, welcome to 3D Asset Management second quarter 2018 market commentary and updated market outlook. I'm Benjamin Levine, Chief Investment Officer for 3D Asset Management. Thank you for joining us. First, some disclosures. The second quarter of 2018 saw global equity markets sell off, much of it attributed to the growing trade dispute that is taking shape between the US and the rest of the world. Based on regional equity and currency performance, the U.S. appears to come out on top of the trade dispute so far, with the S&P 500 gaining 3.4% for the quarter versus a 1.3% loss for MSCI Europe, 2.8% loss for MSCI Japan, and an 8% loss for MSCI Emerging Markets. The trade-weighted dollar also gained 4.9% for the quarter and is now up 6.6% from its lows reached earlier in the year. Global trade dispute is becoming a greater reality for investors. Of the worldwide tariffs announced so far between the US and our trading partners, the Tax Foundation estimates that long-term US GDP would decline 0.44%, along with negative impacts on wages and employment. Investors and much of the financial media are struggling with what to make of the gyrating headlines over trade disputes, European migrant disputes, and increasing exertion of U.S. exceptionalism, such as the non-endorsement of the G7 communique, the bilateral discussions being proposed with North Korea and Russia, and the exertion of pressure on the global banking system to enforce sanctions on Iran. This wrestling with the headlines versus the fundamentals can be summarized by these two contradictory statements separated by just 1 week from Randall W. Forbes, who writes the Up and Down Wall Street column for Barron's. For instance, in the June 16th column, he writes, "The real news of the week from the market's perspective was that mundane fundamentals of growth and monetary conditions count more than hyperventilating trade headlines." Contrast that with this statement from the June 22nd edition, quote, "It would not be an enormous stretch for investors to downgrade global growth expectations due to fears about a trade war," citing Barclays Macro Research. However, the trade and capital flow disputes ultimately are resolved. They create uncertainty for corporate America. Much of the uncertainty surrounding the trade disputes is starting to impact investor risk appetite. Although narrow below investment grade credit spreads and a rallying oil market are giving a lifeline to late stage cyclical reflation. A broader concern is whether market uncertainty surrounding trade will just spill over into global business sentiment with respect to capital spending plans. Diverging monetary policies between the US, which is in a rate tightening mode, versus the rest of the world, where Japan and European central banks remain in quantitative easing mode, has caused concerns that the rest of the world will not be equipped to shoulder the higher interest rate burdens and reduce dollar liquidity from US Fed tightening, especially for foreign borrowers that have issued dollar-denominated debt. Is the Trump trade dispute enough to push key macro and market risk indicators into deflationary territory? We may get a glimpse over the summer, but investors should keep an eye on the term structure and credit spreads as early clues that the U.S. economy may slow down enough for the Jerome Powell Fed to hit the pause button on the rate hike schedule. Hence, our theme for this market commentary is trade dispute, not trade war. Actually, this isn't our quote. It's Treasury Secretary Steve Mnuchin's quote when he did an interview on Fox Business on June 29th, when he said the U.S. is not in a trade war with China, it is in a trade dispute. Yet an undercurrent to the trade dispute that has caused concern among investors is a tightening Fed. Here we show the probability of rate hikes for the remainder of the year, where the base case scenario is for the Fed funds rate to gravitate in a range between 2.25% and 2.5%. And this implies at least one more rate hike, if not two more rate hikes for the remainder of the year. Much of the conflicting picture between risk-on cyclical reflation and risk-off deflationary concerns can be sourced to the Federal Reserve as they continue to embark upon their rate tightening schedule for the purposes of normalizing monetary policies and removing vestiges of the Fed put. In addition to the financial tightening that the rate hikes are starting to produce, The Fed's reactionary function to market disrupting events can be viewed more as a Fed strangle rather than a Fed put. Credit goes to Stifel financial macro strategist Barry Bannister for coining the strangle concept, which posits that the Fed has theoretically sold both a put and a call option, but with much wider strike prices around current market levels versus what may have been observed with prior Fed regimes. Wider strike prices imply a lower probability of those put and call options from being exercised. Under Fed Chairperson Jerome Powell, the imputed strike price on the Fed put is at a much lower level versus prior Fed regimes, which were more sensitive to deflationary spirals brought on by the onset of volatile markets post the 2008 Great Recession. In other words, the Powell Fed is less likely to step in to support the markets during a price swoon, and the sell-off would need to be much deeper to compel the Fed to react. In contrast, the high imputed strike price on the Fed call makes the call option less likely to be exercised, as the Fed's monetary policy seems to be more sensitive to market imbalances brought on by runaway asset prices or excessive risk-taking. As long as the U.S. economy continues to grow despite peak employment levels, with inflationary threats just around the corner, the Fed can maintain the policy strangle while pursuing a rate normalization schedule that brings short-term rates in line with the theoretical neutral real rate of interest, which is the interest rate that allows the economy to continue to grow without inflationary pressures from building up. It will be interesting to see how the Powell would react to how the Powell Fed would react to a deflationary scare before the Fed funds rate reaches or exceeds the neutral rate of interest expected sometime in mid-2019 based on current Fed projections. As we mentioned before, diverging monetary policies between the US versus the rest of the world has concerns that the rest of the world will not be equipped to shoulder the higher interest rate burdens and reduced dollar liquidity from US Fed tightening, especially for foreign borrowers that have issued dollar-denominated debt. Apart from trade disputes, the Fed remains the primary concern among investors as prior tightening regimes have ended with US in recession and the rest of the world suffering from the loss of dollar liquidity. The diverging performance between US assets, whether in equities, fixed income, or currency, versus the rest of the world has produced a widening gap in relative valuations based on price to expected earnings over the next 12 months. However, the key to forward valuations is whether the E in PE or earnings can be stabilized. In the case of emerging markets, earnings estimates are starting to drop, although they continue to grow in Europe and Japan. A concern about Fed tightening has been the tightening in financial conditions themselves. And really, this is a measure of how easy or how difficult it is for borrowers to come to the marketplace to borrow debt. Here we show two indicators of financial conditions: the Bloomberg Financial Conditions Index and the St. Louis Financial Stress Index. After having tightened throughout the first quarter and early second quarter, U.S. financial conditions have actually appeared to stabilize for now. However, the same can't be said for the rest of the world. Here we show the Financial Conditions Index for across Europe and across Asia ex-Japan. Both have dropped throughout the quarter, especially in the broader Asian area. Conditions are tightening across Europe and Japan and Asia, perhaps as a fallout of tighter U.S. Fed policy and a stronger U.S. dollar, which have produced lower liquidity. We're also seeing conflicting bond market signals over the long-term inflationary outlook. Here we show the spread in the U.S. term structure, which is the spread between short-term rates and long-term treasury rates, against the five-year forward break-even U.S. Spread, which is basically the spread between long-term TIPS pricing versus nominal treasuries. In the first quarter review, we noted how five-year forward inflation expectations and the flattening of the 2 to 10-year U.S. Treasury term structure suggested that fixed income investors were not expecting an upsurge in long-term inflation and implied that there was a lid to Federal Reserve rate hikes. If the markets were concerned about the economy sliding to a deflationary recession, then we would likely see those concerns being priced into long-term inflation expectations dropping well below 2% and the term structure inverting with short-term rates exceeding long-term rates. But we are seeing conflict because the five-year forward rate still shows inflation expectations comfortably above 2%, but the 2 to 10 year term structure flattening to levels indicating that perhaps we're about to see the end of federal rate hikes or else we would likely tip over into a deflationary spiral, which would be a main concern of the Fed. Corporate borrowing has also gotten more expensive. We wrote a blog piece in June talking about the increased risks that investors are facing within within the corporate asset class. One thing to note is that during the quarter, AT&T had prevailed in its antitrust case against the Justice Department as the judge approved the acquisition of Time Warner. Why is this important? Well, AT&T's total debt load has now reached $249 billion, 180 of which is funded by the markets. This makes AT&T the most indebted non-government, non-financial rated corporate issuer, according to Moody's, following a downgrade of AT&T's most senior debt from Baa1 to Baa2. The broader issue is the overall level of corporate borrowing. According to Grant's Interest Rate Observer, business debt as a percent of GDP has reached 72.3%, which has exceeded the prior peak of 68.8% in the first quarter of 2007 prior to the Great Recession. U.S. businesses have little margin for error should the U.S. economy falter. The good news, though, for U.S. high-yield investors is that overall credit metrics still look benign, even for the most levered cohort of borrowers. As the credit cycle enters its late stage, key metrics are stronger than before the start of prior recessions, pointing towards lower expected default rates in the near term, according to Fitch Ratings from an early June report. Fitch points out that the distress ratio, defined as the number of distressed credits as a percent of speculative grade market for high-yield borrowers, stands at 4% versus 10% in late 1999 and late 2007, both late cycle years that preceded the last two recessions. Fitch goes on to observe that this credit cycle is reminiscent of the 2006-2007 period, which was characterized by a strong economy, open leveraged financial markets, and a low default environment. For 2018, Fitch is forecasting a 2% default rate. Investors recognize that the current macro environment is still supportive of taking on credit risk, but have chosen to focus this risk-taking on the short end of the yield curve as the Federal Reserve maintains its rate tightening schedule. According to Fitch, the U.S. institutional leveraged loan market has narrowly surpassed that of high-yield bonds for the first time since 2008, and that the size of the leveraged loan market has reached $1.22 trillion at the end of May 2018, with technology companies comprising much of the recent new issuance. Fitch estimates that $17 billion has flowed into the bank loan mutual funds since the start of 2017. And since the start of 2018, Bloomberg estimates $1.57 billion has flowed into bank loan exchange traded funds, or ETFs, in contrast to $5.91 billion net outflows from traditional high yield ETFs since the beginning of the year. Yet the window for low cost borrowing on easy credit terms may be closing as the Federal Reserve remains committed to its rate hike schedule. So a shortening of the credit cycle runway may begin with tighter financial conditions driven by the Fed, which will drive up borrowing costs. The issue then becomes which speculative grade borrowers can weather the higher borrowing costs, assuming a benign macro environment. And if you throw in a business cycle downturn, well, all bets are off. So whether due to higher interest rates creating tighter financial conditions, a slowdown in the global macro environment, or increased issuance from marginal credit-worthy borrowers, one shouldn't be surprised that credit spreads have widened, especially at the lower end of investment grade, although these spreads remain narrow versus historical levels. But credit risk is ultimately exponential in nature, as highly levered borrowers may be able to absorb one hit, but not several all at once. With narrow credit spreads and a debt market increasingly dominated by highly levered, less credit-worthy borrowers and covenant-light issuance, fixed income investors should indeed tread more carefully, regardless of the global growth environment, whether it's traditional high yield or emerging market debt. If investors want to take on equity risk, they should consider taking it in their equity portfolios rather than fixed income. As for commodities, the global supply demand picture has returned to balance after operating in a net deficit over the past year as the oil price rally has led to higher oil production. However, slightly lower demand has met increasing supply. Trailing 12-month global demand dropped slightly in June, although this was after a sharp increase over the prior 11 months. Commodity investors banking on further oil price rallies should be mindful of a potential tapering off in demand. We've noted this as a longer term risk, but we did see that the Chinese currency or the Chinese yuan did sell off versus the dollar, which is a possible sign of increased risk coming into the marketplace. As we noted in prior commentaries, the systemic risk faced by China's financial borrowing does pose a potential long-term threat to global stability and the global macro picture. We noted that total China credit as a percent of GDP has grown to 329% through May 2007, and that the 2017, and that the cost of servicing that has outgrown China's economic output since 2012. In the absence of large-scale defaults, China's debt service burden is being financed with yet even more debt. And the risk of capital flight, which could draw down foreign exchange reserves and lead to a dramatic maxi devaluation of the currency, would be the end result, in essence, causing a total currency collapse and potentially affecting broader capital markets through contagion. So the key short-term risks for 2018 remain that can the market ride continue without central bank training wheels, meaning the removal of the Fed put? The outcome of the 2018 midterm elections, I'm sure, is weighing on investors' minds. Trade war rhetoric is actually now turning into actual tariffs, and we're seeing a repricing of risk in the face of tighter financial conditions. So we would expect to see valuations to remain lower than the peak levels that we saw in January for equity markets, and we shouldn't be surprised to see credit spreads widen in the face of rising Federal Reserve rate as well as lower dollar liquidity. The story for the second quarter was the U.S. as they outperformed well ahead of international markets. The U.S. was up, the S&P 500 was up 3.4% for the quarter versus a loss of 1.2% for EFA and an 8% loss for emerging markets. Fixed income, similar story because of a strong dollar. U.S. fixed income outperformed non-U.S. fixed income, although you can see that it was slightly negative for the broader investment grade market as measured by Barclays Aggregate Bond Index. High yield continues to remain in favor. It was actually up 1% for the quarter. REITs performed well, up 8.5%, partly as a result of recovering from a steep first quarter loss. And commodities continue to be the strong performing asset class this year, led by oil prices. Precious metals have suffered from tighter Fed and as well as more confidence in the market, at least on the U.S. market side, as far as the backdrop is concerned. We're continuing to see growth outperform value, although this quarter, because of the trade war rhetoric, investor sentiment sharply shifted towards small caps, as you can see by the S&P 600 index or the small cap index, performing well ahead of the S&P 500 or large cap index this quarter. Cyclical leadership was mixed between cyclicals and defensives. Energy outperformed on the back of a strong oil price rally, but you can see that real estate and utilities were some of the sector leaders sort of indicating a defensive shift. We saw this defensive shift occur in June as the trade war rhetoric had certainly picked up. Technology continues to be a strong performer, and then we also saw a rebound in consumer discretionary, although much of this was driven by Amazon. Tech's dominance is being captured in momentum. Up until the last couple of weeks of the quarter, momentum was the strongest performing factor and then gave up some of its leadership late in the quarter. When we survey our own writings, we find ourselves occasionally whipsawed by the narrative of the moment, just as we saw with Round of Forbes with the trade war rhetoric. For instance, early in the quarter, we commented on how investors were starting to abandon momentum style investing, only for it to become one of the best performing factors as it advanced well ahead of all the major factors before tanking 2 weeks prior to the end of the second quarter. Low minimum volatility strategies outperformed the second quarter following a late June rotation to defensive segments of the market. Investors turned sharply towards risk off near the end of June as the sound volume surrounding trade dispute rhetoric reached 11. That's a Spinal Tap reference. Defensive sectors such as consumer staples and bond proxy sectors such as utilities and real estate outperformed in June, which helped contribute to low volatility, minimum volatility factors outperformance versus the broader market. You can see here that the S&P performed well above the major equity market regions. Europe, Japan were down. Pacific ex-Japan was also down, and then emerging markets was the weakest performing region. In a somewhat contradictory fashion, defensive rate-sensitive sectors such as REITs and utilities performed well, as did commodities. Normally, these two would diverge in terms of performance, but both sectors were up sharply for the quarter. Much of the rally in the sort of kind of defensive area of the market occurred late in the quarter as investors moved to more defensive positioning concerning the elevated trade war rhetoric and retaliatory tariffs that were being announced. Another divergence we're seeing is the performance between oil and industrial metals. You can see that late in the quarter, industrial metals had sold off. Part of this, I think, is due to the trade war issue, but oil prices continue to rally. And some of this is being driven by near-term supply concerns coming out of Libya, as well as the sanctions on Iran. So it could be transitory, but you can see at least for the moment that industrial metals and oil are sending conflicting signals. Well, this concludes our second quarter market commentary. Thank you again for listening through this commentary. If you have any questions, please feel free to email us or contact us directly. As a reminder, we will post a separate presentation discussing performance attribution of our ETF managed model strategies. If you are a contracted advisor, keep an eye out for a link to the performance attribution webcast. Again, this is Benjamin Levine with 3D Asset Management. Thank you for joining us, and we're signing off.